Well, welcome friends to our weekly High Rock video. If you are watching for the first time and are interested in learning more about High Rock, please check out our website at highrockcapital.ca. I'm Scott Tomlinson, and with me is my partner and colleague and the founder of High Rock, Paul Tepsich. Today we're going to talk about our 3 asset models and any updates or developments in and around our tactical strategies and what we see happening in the global economy and financial markets and other issues that we feel are pertinent to the world of wealth management. So Paul, let's start with any updates on either our fixed income or our tactical strategies.
Yeah, we do have some. We haven't given an update on these models in a little while, so I may go back a little bit further than just a week. But one thing in fixed income, we have done 2 things actually. One, we sold out of a 30-year Enbridge pipeline bond and moved inside the curve a little bit to the 10-year sector and bought another investment grade bond, but TELUS Communications, which everybody is probably aware of as well. And that was one shift. The other shift we made was in our fixed income model as well, where we sold an Enbridge Inc., the holding company, preferred share. And we haven't rebought another preferred share at this stage, but we're almost out of this Enbridge preferred share. We still have a little bit more to sell, but it's pretty much gone. And the reasoning behind that is twofold. Number one, we wanted to move inside the curve a little bit, although the curve is still flattening for the most part. It's been a huge move on the flattening side. And number two, the Enbridge credit in itself, I am less comfortable with, although it did receive a little bit of a boost. And we took advantage of that and have sold the majority of our Enbridge position. So as most of our listeners, clients, readers are aware, and if they're following the press, Canada has not been a very business-friendly environment for energy companies of any sort, whether they be pipelines or drillers or exploration and production companies. So we have limited some exposure that way. In our global equity model, we could probably also add, Scott, that we bought a little bit of stuff for some securities just for newer clients, but we haven't had any major shifts or investments in that model. And tactically, we have had a couple shifts. We added the one positive, I think, in the Canadian energy space, the one that I am somewhat pumped up about is LNG Canada. I think this is going to go through. We saw Petronas buy, I think, a 25% stake in the project. This is a $40 billion project to move liquefied natural gas through northeastern BC and the Montney area to the BC coast and transport it to Asian markets. And I think this is going to be, there are a lot of really interesting ways to play this if it goes through, which I kind of have reason to believe it will. And the one way we're playing it is we bought a high yield natural gas bond, which it's a company I know pretty well. It's a bond I know well. And we're going to play it that way. It's a little safer than buying the underlying, a lot safer than buying the underlying stock of that particular company and many other companies. So we're collecting our coupon every day, and I think it's well covered and protected by its covenant package, and we will use that as our play. I think it's a good risk-adjusted return play on this LNG project going ahead, which we will find out somewhere close to the end of the year. And away from that one, we sold the balance of our Baytex energy stock. It popped up, and we had some of our newer clients had a really good move on that one. So anyway, we sold our position in entirety, and that's a U.S. and Canadian oil company. That, I believe, is it. That's a full recap.
Excellent. That's great. That's a great update. Thanks for that. Another thing that we consider to be part of tactical strategic positioning for our portfolios is the use of having US dollars in client accounts. Last year, just around this time, with the Canadian dollar strengthening, we added um, um, about a 5% weight to most clients, or got a lot of clients up to speed. And I know that we've been looking at for other opportunities to add. But this morning we saw the Canadian dollar weaken off a little bit, and I think again we're watching markets sort of juggle between what's going on with NAFTA and what's coming next, perhaps from the Bank of Canada, and that's put a bit of volatility into the Canadian dollar. But as the Canadian dollar weakens, obviously that benefits our U.S. dollar holdings because all of our client portfolios are actually denominated in Canadian dollars. So when you see if you look at your statements, or if you look at your quarterly reports, or even your look online, you see that everything is denominated in Canadian dollars. So having U.S. dollar exposure does become somewhat of a tactical maneuver from a strategic perspective for our portfolios. So that's just another thing that we keep in mind. But I think our view longer term is potentially for a weaker Canadian dollar. Paul, is that still something that you believe in as well?
It is, and in fact, I went to go buy some for some newer clients today, some U.S. dollars, that is, against Canada. I went to buy some yesterday, but kind of missed it, and it weakened off, and then it weakened off again today. So we'll look for a very small pullback. But yeah, I think this Canadian dollar can really weaken off. And Scott, we should probably mention as well, is obviously we have an election in Ontario on Thursday. Looks like the PCs are leading in the polls on seat acquisitions, which would be good. But if not, the NDP are polling very, very well. Should they get in power, I would think the Canadian dollar is going to get hurt really badly. So I wouldn't mind being able to buy some before Thursday, but just as protection for some of the newer clients who don't own U.S. dollars.
Makes sense. We talk pretty much each week about the yield curve, and it's important to us because we do believe that as the curve does flatten, and as you said, for some strategic moves in some of our bonds, you've been watching the curve, and it's definitely been flattening both in the United States and in Canada. One of the things, of course, that we are focused on is that when the curve flattens, usually, as you can see in this chart, a recession tends to follow after the fact. Now, interestingly, we have started to see a lot more of the free trade or the trade protectionism enter into the picture. And you and I discussed this a little bit late last week, but one of the things that I wrote a blog on last Friday was, well, what happens economically, what happens to inflation, things like that when this occurs. And we talked a little bit about when was the last time we saw that kind of scenario where you had a weakening economy and inflation pressures still rising. And that's the likelihood of the impact of a trade war, is that you get downward pressure on economic growth, and yet cost pressures still continue to rise because of the tariffs. And we look back, and it was really the late 70s, early 80s that we last saw that kind of what we call stagflation. And then we had a look to see what the U.S. yield curve did, and it in fact inverted and quite significantly, correct?
Yeah, a lot. Well, the most ever on record, I believe.
Yeah, and which means from that perspective, if we do see that where central banks continue to have to push short-term rates up to fight inflation, and yet you get a weakening off of the economy at the same time, that obviously is not a positive thing for economic growth. So obviously we keep an eye on how these things unfold and manifest themselves, but certainly with heightened trade tensions, this is some of the caution that comes into our decision making. Sorry, Canadian. Whoops, Going the wrong way on my slides here. Sorry, folks. Canadian yield curve I mentioned earlier. Again, last week it had narrowed to about 40 basis points over the course of last week. It got as low as around 35 or thereabouts, back up to about 38 now, but still the trend of flattening yield curve continues. Paul,
in a lot of my conversations with people, Scott, guys who are not, don't come from a fixed income background and may not look at these things on a daily or weekly basis like we do. Just say that the yield curve is telling us something here.
Yeah,
and it's worth paying attention to.
Yeah, absolutely. We don't disagree. I don't disagree. And as we've always said, bond markets, given their global scale, tend to lead other financial markets. And this is, again, why we keep such a close eye on what's going on. And it's not front page news right now. So, and that's something that may become front page news down the road. Paul, you keep a pretty close eye on what's going on, specifically in Toronto in the real estate market. Yesterday, lots of data came out, and the headlines may have been a bit misleading, I imagine, right?
Yeah, they usually are. I mean, they always talk about sales, and sales for sure are important, and it drives real estate broker commissions and turnover. So the analysts, or pardon me, the journalists, typically look at sales, but I don't think they, quite frankly, dig down deep enough or peel back the layers of the onion enough when they look at the real estate market. So I think there are other factors that come into play. So, and in fact, on this slide, we can see a cut and paste from Toronto Real Estate Board is Treb, the Director of Market Analysis, and saying the indications are emerging that there's increasing competition of bidding wars, which is interesting again. But what that graph shows there is the detached average sales price. And obviously for homeowners and everybody, I mean, even if you're not, and certainly if you work at a bank, this is really important. If you're a mortgage lender, the value of the asset is important. And as we can see here, the market peaked in April 2017, and this is for the city of Toronto. Detached average sales price peaked in April 2017, and pretty much, as you can see, went straight down. And it was driven by a ton of new and active listings on the marketplace and a lack of sales at the time. But as you can also see in the far right-hand part of that blue line, we are gravitating back up higher. And the reason for that is year over year. If you go to the next slide, perhaps, Scott, I think we might have it. We have part of it. The reason is I wrote a blog on it today. Actually, that should be my comment. You can look at the blog today and see that new listings and active listings have year over year dropped off enormously. And I think what's going on, and some of the quotes from the folks, the analysts at Treb, is that people just aren't listing their houses to sell, especially detached houses. There is a gap between a detached house and a condo, and their comments were this month, for the month of May, that there aren't enough sort of mid-size houses, if you will. So if you trade down from a big 4-bedroom house, you're finished raising your family, you're not ready to move into a condo, do you move into a semi-detached house? Well, that market is very, very tight, the semi-detached market. The condo market is where all the supply is coming from, and younger millennial types are bidders for condos because some of them qualify and meet the B20 mortgage rules. Older folks, the baby boomers are selling their houses and moving into condos in many cases. So there is good demand for condos, but that is where the supply is coming, and there's massive densification going on in the city. So my view is that the gap between detached houses and condos will continue to move wider and higher, solely based on densification. But the other problem, I think, with the real estate market, Scott, is the friction costs to move are just way too high. You've got the seller pays real estate commissions. And if you're buying another property, you're paying land transfer tax, and these are huge fees to give up. When you think about it, you can stay where you are, save those 2 friction costs, and do a reno, and have more of the house that you want. So I think folks are just not listing because the friction costs are way too high. So I think that's what's going on in the market, and those are my views. We'll see where we fall out. But as you can see, that detached price to sales ratio is the price is quite cheap versus the number of sales going through. But
yeah. Well, anecdotally, if you drive down through many older residential areas, every other house seems like it's being renovated or rebuilt or something, and it's quite interesting that you say people finding it cheaper just to renovate their existing homes as opposed to with the friction costs move to other places. So yeah, interesting commentary.
And not that renos don't have headaches, but moving is a big headache as well, just sort of mentally.
Yeah.
But yeah, no, there's a lot of that going on. And the other anecdotal evidence for the housing market in Toronto, I think, is just traffic. Just drive around on any of the surrounding highways, the Gardner, QEW, 401, Don Valley, 427, 400. It's unbelievable how the city has exploded in the last 30 years. And remember when you and I first started working together 30 years ago almost, do you remember a couple condos going up around the Sky Dome, and people were like, "Oh my God, it's a condo bubble. It's a bust." And lo and behold, sure has not been a bust.
Yeah, and interestingly enough, while all that development in the condo world has happened, there's been almost no infrastructure built to support that, especially in the downtown core. So,
well, that's a really interesting one. Now you've got this Eglinton line going through. When it finally is built and operable, it's going to put a massive amount of strain on the Yonge University line. Then they need to build a relief line, which that's going to take another 12 or 15 years before it's operable.
Yeah.
It's I think it's just poor city planning for the fastest growing city in the developed world.
Yeah.
That's pretty poor planning.
Yeah.
Anyway,
all right,
that's probably enough.
We digress, but that's it, folks, for this week. Thanks for tuning in. Please feel free to send any feedback. We enjoy feedback because it gives us things to talk about. But until then, we'll see you next week, and hope you have a great rest of the week and a spectacular weekend. And let's enjoy the summer.